Hey, good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, April 19th, and we got a few economic news releases scheduled for today. Tomorrow, there'll be none scheduled, so it'll be kind of light for tomorrow, probably more on the headline news tomorrow. But today, we got the weekly jobless claims. Last week, we had 388,000 people applying for unemployment. We figured that number will come down a little bit, and it kind of remained pretty close, about the same. So we had another 386,000 applying for unemployment this past reportings. Another item to note is existing home sales for March. We had 4.6 million up for February. We figured it would climb up slightly to 4.63, and it dropped down to 4.48. So not the greatest of economic news so far. And then the other item to note is leading indicators. We had 0.7%, which means basically this kind of shows you ahead of kind of what's going to happen with the economy if it's going to keep growing. So this is kind of showing some strong growth. So we figured it would drop down to 0.2%, and it came in at 0.3%. So March is usually kind of a slower month anyway, so they're kind of showing that it's going to slow down a little bit, but it's still going to in a expansion stage, meaning that it's still there's some growth there, just not as fast as obviously 0.7%. So not to be too alarmed right there. And then we also had the Philly Fed Index. What that is the manufacturing in the Philadelphia region for April's numbers. We had 12.5 for March. We figured it'd come back a little bit, 10.8, and it dropped quite a bit down to 10 or 8.5. So the last one we had was actually dropped quite a bit. So the economic news is not the greatest here. We do show some expansion, which is kind of probably the most positive sign here. But right now, the other economic news really are kind of taking a backwards. It looks like they're taking a step backwards. So we want to definitely keep an eye on these and see if we're looking to slow down again, or we remain at a steady pace, or where we're going. So before, in the first couple of months, we were getting some really good economic news. Now it looks like things are slowing down again. So let's take a look here at the headline news. And the stock market's up a little bit. You kind of wonder after the economic news releases that were scheduled. A lot of it has to do with it's kind of a mixed mash right now. So I think the investors, you might see a lot of volatility today. But also reporting is they're saying the Italian and Spanish bonds basically didn't do as well. Their yields were kind of climbing up a little bit, and even French found their yields climbing up a little bit. So basically, there's less appetite for the Italian and Spanish bonds at their auctions today. But there's a few companies that with earnings reportings that coming out the first quarter, and that been doing well. So that's kind of it's kind of a mixed mass of what economic news release, what some of the earnings reports coming out, and then what we're hearing from Europe as well. So so there's a lot of things to digest so far this morning. You might see some volatility again. You may see it going up and down later in the afternoon as investors kind of gauge things at. So we'll kind of see where interest rates are moving. Today we got the bond market. Yesterday we started it down. We were testing the 10-day moving average, and then we closed upwards. Today we continued that trend, and right now we're putting pressure on the ceiling at the 103.56 level. So if we can maintain that, we could potentially break above that. But right now, interest rates have a slight improvement from yesterday's numbers, which is obviously a good sign. And so that's the great news. So we'll kind of wait and see what happens. See if we continue to trend upwards, which will improve interest rates, or if the investors cash in and they worsen a little bit. So, all right, folks, you guys have a wonderful day. Stop by mikesdailymarketreport.com and get your free updates. And again, interest rates are a little bit better today. Enjoy.